Hello and welcome to another episode of Darwin Investors. So I believe that inflation is going to be decreasing in a very meaningful way in the very near future. And in this video, I intend to prove it using some math and science and logic. But I don't think I'm the only one cluing into this fact, which is the reason why you see a lot of chatter out there in the media that the Fed may not be as aggressive with their rate hikes going forward, or perhaps they'll even pause them altogether. Now, I'm actually of the belief that they could possibly pause their rate hikes in December using the math that I'm going to show you in this video. Now, for this reason and others, I believe that the stock market could actually rally through to the end of the year, and we could have a little bit of a good run. Of course, there's going to be some ups and there's going to be some downs. I'm just of the belief there's going to be more ups than downs going through to the end of the year. Now, when this happens, I'm going to attempt to detail what I plan to do when this market rallies. Am I going to go into bonds? Am I going to go into certain ETFs like natural gas or perhaps the dollar index, the UUP or something like that? What am I going to get into going forward? A lot that's going to depend on the inflation rate. It's going to depend on interest rates. It's going to depend on the value of the dollar and so forth. And this is just sort of the thing that I take week by week. Now, before we get into all this, I need to first get this out of the way, because in my last video, I showed how I was shorting Twitter, and I did that by buying 2 puts against Twitter, thinking it would go down because I didn't think the company was worth that much money. And I did it when I really didn't understand the entire deal. So let me go ahead and show you where my mistake was in there. So with this Twitter deal, I knew that it wasn't worth $44 billion. Elon Musk knows it's not worth $44 billion, and the people at Twitter know that it's not worth $44 billion. Other people that know it's not worth $44 billion is Morgan Stanley, Bank of America, BNP Paribas, Mizuho Financial, Mitsubishi UFJ, and Barclays Bank, because they're all currently trying to get out of this deal. What they've done is they financed this for $12.5 billion. And they bought all these bonds, and they're trying to sell these bonds to the public, but no one wants to buy them. So these guys are all going to be out a lot of money. So I knew this deal was going south. And for this reason, I bought a couple of puts against Twitter. And that was before I realized that he was taking the company private. I thought he was just going to buy the company and leave them public. But what privatization does is any person that owns a share of Twitter, when he takes this private, is going to get $54.20. So really, there was no way that I could win on these puts unless the deal didn't go through on October 28th. Now, it became painfully clear that the deal is going to go through on October 28th when Elon Musk reportedly wants to lay off 75% of Twitter's staff. Now, you can't lay off staff you don't have. And for all these reasons, I was able to sell my puts back to the market and lost about a total of $300 and learned a valuable lesson about not buying puts on things until you fully look into it. Or maybe I haven't learned a lesson, I'm not sure. And all of this brings me to my sponsor for this week's episode. So guys, have you ever spent $600 buying puts when you can't possibly win and then turn around and make a YouTube video about it? Man, I have. And if you want to do the same thing, look no further than my sponsor this week, which is beer. I think I'm going to buy some calls on Peloton next. And speaking of my sponsor, it looks like this week it's Dogfish Head's Blue Hen. And I give this sponsor 3 Kate Rooneys out of 5. Now let's get back into this episode. Now, among the reasons that I'm bullish on the stock market right now is we just entered the best quarter of the year for the stock market. On average, the fourth quarter we're up 4.0%, and the fourth quarter is actually up 78.9% of the time. The second best quarter would be the first quarter, where we're up on average 2.1%, and we're up 63.4% of the time. Now, to make things even better, we're in a midterm election cycle right now, and during the midterms, we can see that since 1951 to now, the only times that we've ever been negative after a congressional cycle 3 months later would be in 2018 when we were down 0.9%, and in 2002 when we were down 7.8%. Interesting to note here, in my opinion, is we've never been down 6 months later, and we've never been down 12 months later. So I would expect that historians and like the way that the stock market people like to look at stuff like this, they may start putting money in right now, considering that they might believe that they're going to be up 6 months from now and certainly 12 months from now. So it might make the equity market a lot more attractive than them. Another thing that's going to help us out, and a reason that I'm kind of more bullish right now, is if you take a look here at the FOMC trading and external communications blackout calendar, what this says is days that the Fed governors and presidents can't come out and talk to the press. They can't go out on the media and do the thing that they've been doing 3 and 4 times a day, because they're actively right now trying to torpedo the stock market, because they believe that a strong stock market means that inflation will go higher. So every day they come out and they try and drive the stock market down. So even as earnings are good, these guys are trying to bring it down. Now, where it's gray on this calendar, you can see these are days where they're not allowed to speak, and it generally precedes times when the FOMC meeting is about to take place. So if we move over here to October, we can see the last time they were allowed to talk to the media was yesterday. And so they're blacked out now all the way through November 3rd. So next week, we have mega cap tech earnings coming out, and I imagine we're going to have a whole lot of discussion about FX and stuff like that, and foreign exchange. And it doesn't seem to matter when the dollar is weak, but for whatever reason the dollar is strong, this becomes a big deal. So we have the mega cap earnings coming out next week, and I imagine they're going to be decent. But what we're not going to have is the Fed coming out and hammering the stock market every chance they get by running people out like this guy here, this Fed Chair Harker, coming out here and says, hey, we need to get more aggressive with rate hikes because inflation is going up so much. Well, let's talk about the inflation and let's see where we think we're headed. So inflation month over month when it came out in September was 0.4%. And for year over year was up 8.2%. Now this 0.4% read was considered to be very hot by many. And they're like, well, that was more than expected, this 0.4%. So it caused the stock market to behave, at least in the first half of the day, very badly. And we can see here the New York Times was like, the prices rose faster than expected. And Harker came out and says, wow, we got to get more aggressive on rate hikes because 0.4% sure is an awful lot. So let's look deeper at this. So the 0.4% includes shelter here. Shelter was up 0.7%, and shelter itself is actually a very big component of the CPI. And the housing category of expenditure typically accounts for over 40% of total expenditures. Now, if we look at this pie chart right here, you can see that housing accounts for 42% of CPI. And I would imagine includes a much larger percentage of PCE, because CPI includes food and energy, which PCE does not. However, it does include housing. So the CPI inflation, housing is dang near half. Now we're talking about, okay, well, it's up 0.7 month over month. Well, we all know that the price of real estate is actually going down. This number is not accurate. I don't know where they're getting this from. We do know that inflation rate hikes are not going to affect medical care. We do know that the price of plane tickets are going up, so transportation services will probably stay elevated. We also know that energy and commodities are going to be relatively flat for gasoline and fuel and the like. But we also do understand that 0.4 was considered to be really hot read. Now let's have a closer look at this housing data. So home prices are actually decelerating by a record amount. I think we all know this. I think we know that the cost of a home or the price of housing is coming down. Well, someone else that seems to know that the cost of housing is going down. Lord knows the Fed doesn't know this, but let's see here. The cost of housing here, let's see, price cut, $10,000. This is Lehi, Utah. This is where my wife is from, so I'm looking at these houses here. Let's see, price cut, $25,000. How about this one over here? Let's see, price cut $5,000. You get the point. All these homes are being cut in price because interest rates are spiking and you can't sell a house. You've got to lower the price of a house. This number right here, where it says that things are going up 0.7% month over month, this is not accurate. However, it does seem to be lagging. So what that means is that some months ago, if they're saying, well, this lags so many months behind, what that means is that months ago it was higher than it showed it was. So maybe in that inflation, instead of being 9%, was closer to 12%, maybe. Who knows how high this number was? And now it's artificially inflated, as we know it's coming down. But buying homes isn't the only thing. We're also going to be considering rent. And the average annual U.S. rent price growth has slowed for 3 months. That was in July. It's actually slowed 5 months in a row. So rents are coming down. The cost of housing is coming down. And so this number here, you would think would be really close to what this would be here, say for used cars and trucks. It should be starting to look negative, at least at some point in the future here. But let's go ahead and look at this number 0.4% and decide whether, and we all know that this is supposedly a really nasty number, 0.4%. So let's go ahead and look at it and figure out where inflation is actually headed. What direction are we going in? So if you look at the CPI, this is over the past year, we can see that this is the way that this number is they get this number. So they take this number here, 296.761 that you can say for September there, and they divide that number by this number here, 274.214. And you're going to get the 8.2%, which is the inflation rate that everybody was complaining about, and understandably so. You know, it's very high. Now, let's say that this number goes up 0.4% every single month. Every month. It goes all the way until June here of 2022. So what we would do is we can assume that next month, if it goes up 0.4%, again, 296.761 times 1.004, that gets us 297.94. Now, if we take that and we divide it by October of a year ago, which is 276.590, we can see that the new inflation rate next month is going to be 7.7%. Now, if we do that every month on this steep curve here, all the way up to June, let's figure out what our inflation rate is going to be in June of 2023. And all we're going to do is just multiply this number by 0.4%, which we all agree is high, every single month until next June. There's October, November, December, January, February, March, April, May, June. Now let's divide that by this number of June here, which is 295.328. 295.328. And so our inflation rate in June of 2023 going up by 0.4% a month, which everybody was really having a coronary about, puts us at an inflation rate of 4.1% of June of 2023. Now, why is this important? Well, it's important because our current Fed funds rate is 3% to 3.25%. Now, they've already indicated that they're going to give a 0.7 or 75 basis point hike in November, or 0.75%. That would bring our Fed funds rate to 3.75 to 4%. If they do another 50 basis point hike in December, that's going to get us to 4.25 to 4.50%. Well, we can already see now that if we're sitting at 4.5% Fed funds rate and we're expected to get to 4.1% in June of 2023, we are now neutral. Because we're going to be neutral, the Fed has done this thing where they went ahead and leaked out information that said, hey, listen, we'll do this 75 basis point hike this month because that gets us really close to neutral. And after that, we're going to have to debate the size of future hikes. Now, they've leaked this thing out. And not only that, Chair Powell has also said, Mary Daly, why don't you go out there and let everybody know that we might start planning for smaller rate hikes in the future. And this sent the market up in a straight line because now we're starting to see the light at the end of the tunnel. So what am I going to be doing with all of this information? Well, I do expect the market is going to go up more than it goes down by the end of the year. And so I'm going to do a fair bit of tax loss harvesting. Now, when I click on this right here, realize gains and losses, it doesn't let me show you what I've made so far this year, but I'll just let you know I'm up roughly $10,300 or so. And so I'm going to have to sell some equities that are going to allow me to not pay taxes this year. But not only am I going to take $10,300 worth of losses, I'm actually going to write off an additional $3,000. So I'm going to take about $14,000 or $15,000 if the year were to end today in tax loss harvesting. And I think this is disgraceful because what the Fed's doing right now is they're cranking up the rates really high, which means that anyone that buys a bond, the government now has to pay them more money. They have to pay them 4%, even on a very short duration bond. The 1 month is paying 3.47% per year. Now this is annualized, but it's paying, the 1 month is paying 3.47%, the 3 month 4%, the 6 month is 4.47%. I can see where a lot of people would want to take advantage of this. Now, if you pull your money out early and the bond goes down, you're going to be penalized. However, if you let it go to maturity, you're going to get all that money there. And so short-term bonds have become fairly attractive. And what's attractive to us is no good for the government. I mean, the government's going to have to pay all this money out. And then the other problem that they've got is that the stock market has wiped out $9 trillion, and this is through September 27th, $9 trillion of America's wealth. Now, let's say that by the end of the year, it's $10 trillion. Who knows where it's at right now? So I'm going to be tax loss harvesting. This is $2 trillion that the United States is losing out on in their treasury just by hammering our stock market. They're losing out on $2 trillion. And I've lost so much this year that it's very likely that I'm going to be tax loss harvesting next year as well. So the government's losing out on an awful lot of money with these high interest rate hikes. And then also when it's at 4.1% next year, the housing sector is still going to be looking at about 6.5 to 7.5% financing on these homes. And that's unsustainable unless the price of homes come way down. So I would imagine that even at 4.1%, we're going to see unemployment start ticking up, and they're going to have to do one of two things: either plunge us into a nasty recession, or they're going to have to lower interest rates so people can go to work, because the housing market right now is about 17% of GDP, and the car market's about 3%. So you're going to wipe out right off the top 20% of American workers right there, and you're not going to collect any money, and you're going to be paying more money out for every single bond that you sell. It doesn't make any sense to me, but this is the plan. So what other things can we invest in? Well, there's ETFs out there. There's all kinds of interesting ones that might be an interesting choice for some. There's the UUP. The UUP tracks the dollar index. Now, if interest rates come down, the dollar is actually going to weaken versus the rest of the world. However, if interest rates still keep going up and up and up, the UUP will also go up and up and up. And you can see that the dollar index has, this is the last year, has gone up 19.67. Maybe when I'm selling all of my equities and tax loss harvesting, I'm going to reallocate into stuff like this UUP. That's if interest rates stay high. Now, another one that might interest you is this BIL. It's the Spider Bloomberg 1 to 3 month Treasury bill. Right now, they're trading for $91.56 a share. You can see that this can appreciate with time. It's gone up 0.12% over the past year. It pays the monthly distribution of 0.37%. If we take 0.37% and you multiply that by 12, it gets you roughly the rate of 4.44, which would be your 3 month treasury. Maybe you're getting a little bit a premium there because you are taking a risk, because this thing does go down as well as up. So maybe that's what they're doing. Every month right now, you can see that because the Treasury has been going up so rapidly, you used to get 5 cents a share, then 10 cents, then 14 cents, and lately here it's been 16 cents a share. Now, if this is the sort of thing that floats your boat, it isn't the sort of thing that floats mine. Let's say that you're gonna get 100 of these things, right? So you pay $9,100 for these, and you divide that by 91.56, so it's 100 shares, makes 100, and then you're going to get 16 cents a share. This is for $10,000 worth almost, and your monthly return is only 16 bucks. So for $10,000, you're getting $16 a month, and you may or may not get your money back. So that's one thing to consider. Another thing to consider might be something like a BOIL here, which is the natural gas ETF. Now, this is a leveraged ETF. It might not be the sort of thing you'd want, but I'm just saying that it's here and you can get it if you want it. And this one over the year is down 59%, but you can actually bet on natural gas futures. I mean, there's so many different ways that you can play this market. You can, of course, get XLE, and XLE would be your energy ETF if you want to do something like that one. And this one pays a dividend of 4.25%, which is about the same as the federal funds rate. You know, that would be the return on a 10-year note. And this thing has gone up 47.84% over the year. So these are all different things you could do. Myself, I'm probably just going to stick around and just do my normal investing I do. I'm in a bunch of conservative companies. I've looked at it. I always feel like I'm in the best companies I could possibly be in with Adobe and Microsoft, Amazon, Google. I mean, I'm not exactly bottom feeding here. I have a lot of confidence in this. And the chart does say that over the next year, I should be up 6 months after this election and 12 months after this election. And that's every time that's happened since 1951. So I'm going to put all my faith and confidence in that. I also believe that the Fed is actually going to pause in December, and things should look a little bit more pleasant for us investors, say in the near future. Those are my beliefs. All right, at least that's my belief today. So if you get anything else video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye.